For over a decade, revenue recognition has been at the center point of discussion in the accounting world for many reasons. For complexity, lack of comparability, a lot of industry guidance associated with revenue recognition. Revenue is one of the most important measurements used in measuring the performance of an entity, used by investors and other users of financial statements. So because of that importance and the complexity, the boards, the International Accounting Standards Board and the Financial Accounting Standards Board, listen to stakeholders' concerns associated with the level of guidance on the U.S. side and the lack of guidance on the international side. In May of 2014, the FASB and the IASB issued a completely converged and comprehensive standard for revenue recognition that will literally take out every piece of revenue recognition guidance on both sets of frameworks. In the U.S. and under IFRS, there's a principle that underpins the new standard, and that principle is revenue is recognized as goods or services are transferred to a customer in exchange for consideration that the entity expects to be received associated with those goods and services that are transferred. The board developed 5 steps to apply this principle. The first criteria is a contract with the customer. The contract with the customer is a legal obligation for the entity to deliver goods or services to the customer. The second step is determining the performance obligations in the contract. In determining performance obligations, the entity must determine what goods or services are distinct, and that means whether they're capable of being distinct or they're distinct from other goods or services within the contract. The third criteria is determining the transaction price. And we'll pause here for a minute because this is a fundamental shift in accounting, more specifically as it relates to variable consideration. Current guidance, you have to have a fixed or determinable price. In the new standard, you would have to estimate that variable consideration and consider the constraint that has on the variable consideration. In other words, if it is probable that there is not a significant reversal of revenue, then that variable consideration will be included in the transaction price. The fourth criteria is allocating the transaction price to the performance obligations. And what one will find that's similar to the methodology used in current multiple element arrangement accounting. The fifth criteria is determining when to recognize revenue. You will recognize revenue over a period of time or at a point in time. Those are the 5 criteria that you must meet to recognize revenue in the current standard.